Hi, everyone. I'm your host, Rob Campbell, and welcome to The Art of Boring, the podcast where we dive deeper into Mawer's investment philosophy and thinking in order to make you, our listeners, more informed investors. Ultimately, we hope to connect you with the people at Mawer who find excitement in be boring, make money.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
Well, we're here this week to talk about portfolio construction. And we thought who better to do that than our U.S. equity portfolio manager, just given everything happening in the U.S. these days. So, Grayson, welcome to the podcast.
Thanks, Rob. It's good to be here.
Yeah. And so here's how I was thinking about this. Mawer is primarily a bottom-up stock picker. Portfolio construction might be just as simple as putting the most weight into your best ideas and taking it from there. It's more than that, though, isn't it?
Yeah, you're right. There is more to it than that. Yeah, I think you made a good point to kind of kick it off. We are bottom-up stock pickers, and so that's where the genesis of the stocks we look at. We try and find the best stocks out there. But there's different ways you could create a portfolio out of that. You could set a threshold and say everything above that threshold could fit in the portfolio, and you just pick the ones with the highest expected return. That could be one way to do it. But the future is uncertain, and you want to build resilient portfolios. That's a big part of the way we do things, is that resiliency in the portfolio. So we want to build the right skew in one way. So you can look at it from a bottom-up standpoint. So there's the skew in terms of the distribution for a single stock. So that's one way that we often talk about, where you want to have the negative skew limited and the positive skew unlimited. So you might have a company like Waters that makes equipment for the pharmaceutical industry. And you might say, well, they're locked in because they do quality control for pharma companies. And so those machines are locked in for as long as they make that pill, whether it's branded or generic. So that's great downside protection. And then you have upside of them selling new products to different customers. So that's one way that you have intrinsically. But in terms of the portfolio construction, you want to add more to it than that. And so we have a constructed portfolios of typically 50 to 70 holdings. There's hard restrictions in terms of 20% max per industry, 6% max per stock. So these are guardrails really against overconfidence. Those are simple things we have in place. But I think it's also key to mention why we do some diversification. One reason is for downside protection, but another reason is for upside capture as well. So you're never going to pick the best performing stock in the universe. And so you want to have diversification on those two fronts too. So I think it's important to think about it from a return and a risk standpoint.
How do you think about diversification? Because that is probably my favorite quote in investing, which is that diversification is the only rational deployment of our ignorance, which I think is the theme that you're getting at. I get that and clients should rest assured that we do have some maximum guidelines with respect to how much we can put into a stock or a given sector or industry rather, but diversification's got to be so much more than that. And so as a portfolio manager, how are you thinking about that on a day-to-day basis?
You're right. So diversification, one way to think about it would be, it's like slicing a cake. And so you can slice a cake in many different ways if you think about a birthday cake. And you want to be diversified in every different way you look at it. So maybe you slice it right down the middle and you can see the different layers, but you might also want to slice it horizontally. And that's a totally different look to the cake. And so that's the way we often think about things, is we want to be diversified in as many ways as possible. There's different ways we look at it to help do that. One is having contradictions in the portfolio. So when we create portfolios, we're aware that we aren't able to predict the future. If we were, we could just pick one stock or one industry and say, well, this industry is going to do the best out of every industry, and let's just pick only stocks in this industry. But we don't know that. That's not the case. We don't know how the world is going to unfold. And so we want to build some contradictions in our portfolio. For example, we haven't had oil exposure in the U.S. equity fund for several years now, oil and gas exposure. And so that's worked fairly well for us. But recently we've added to companies like Aspen and FleetCor, which are derivative plays on oil and gas exposure. And the reason is because we're not sure what's going to happen in oil and gas prices. And so we want to have some offsets in the portfolio. So that's one way of doing it. Another way of looking at risk is through the matrix. So the matrix is a tool we have that looks at basically quality versus return potential. And the way we use this in risk is trying to diversify along that continuum. So we might own a company like West Pharmaceutical, which is a very high quality company in our opinion, but the return potential is not as great as some others in the portfolio. But we diversify along that potential, along that kind of gradient. And we may also buy companies like State Street, which is it's a high quality company, but just not as high as West Pharmaceuticals. But the valuation is, in many regards, is more attractive. And so you diversify along that, the gradient of the matrix on a quality and return potential. So that would be one other way of diversifying.
So taking it from there, and again, I think you just have such great perspective managing a US equity portfolio in these various ways of slicing the cake. I mean, you hinted at one that I know a lot of people in the investing world are really thinking about, which is this idea of value investing versus quality versus growth, and just how that theme plays out in a portfolio or in putting together pieces of portfolio. Can you go just a little bit deeper on that one? So recognizing that you do want to hold stocks across the matrix, how are you weighing the impact of that theme on the portfolio overall?
Yeah, in our mind, it's a continuum. So we understand there's this traditional groupings of value and growth and these type of buckets, but we view it as a continuum. And so we try and diversify the portfolio all the way across that. And so we think about the matrix, we think about these kind of bands that we invest in. And the band can be, it's really a mix. You think about a mix between quality and return potential, and there can be different mixes that lead to the same weight in the portfolio. And so it may be companies that are more value-based might have a mix that's appropriate for us, where you say, it's a high-quality company, it meets our threshold, but the return potential is one of the better ones in the portfolio. And so we have a certain weight in the portfolio. A company like that could be a company like Cognizant, for example. So they do technology consulting. So it's a reasonable business, but the valuation is quite attractive. And then you go all the way across the spectrum to a lot of the higher quality companies that we own. And the mix is right for those too, where the return potential is decent, but the quality of management, the quality of business model is exceptionally high. So we think they're going to create a lot of value over time.
So just pushing on that one a little bit more, are there specific things that you're doing, either as a team or as a portfolio manager, to kind of assess the resilience of the portfolio? Do you play out certain scenarios, again, without knowing how the future is going to unfold? Do you look at various interest rate scenarios or economic scenarios and try to understand how that might play out and impact the resilience of the portfolio?
Absolutely. So we look at it in a number of different ways. So one way that comes to mind is on the valuation front, our models, we can look at different interest rate scenarios. So for example, if interest rates stay low or they go higher, or they stay low and then go higher, all different scenarios, we can play around with those and see how that impacts the valuation. So that's one way of looking at things. We also look at it on a more qualitative basis. So we can look at different factors, different risks in the portfolio, and try and aggregate those. So we may say, what companies have oil as a raw material, and see, okay, how much of that exposure do you want to have, where a big increase in oil prices could lead to lower margins for the company? Or it could be, how much exposure do we have exporting products to China, for example? And so especially around the tariff talks a couple of years ago, we were very cognizant of having a lot of exposure to companies that are exporting a lot to China, for example. So we look at all these different factors and we can aggregate them for the portfolio and determine if we think that's too much risk or a reasonable amount of risk and it's diversified enough. There's things like that. There's also other one-off projects we do on a regular basis to look at risks in a different limelight. So one that we recently did was looking at risk through the lens of behavioral biases. So often in investing, humans have these cognitive biases built into us, good reasons in many cases, but we want to be aware of these and we want to make sure that they're not skewing our investment decisions. And so we look through the whole portfolio based on some of these biases, things like confirmation bias, endowment effect, fantastic object. And we tried to see, do we think we're making any structural biases where we're making the same mistake over and over again in the portfolio in the way we look at things? Luckily, we believe we aren't, that we're pretty diversified on that front and we're aware of these biases and we're trying to correct them. And part of the way we do that, on top of doing these exercises, is that we have a team. The U.S. team, for example, and the whole research team is diversified. The U.S. team grew up in 4 different continents. And so it's just, we look at things from different standpoints, it's different viewpoints. And so I think that intellectual curiosity, that diversity in the team itself is kind of led to us avoiding some of these behavioral biases. So I think there's a number of different angles we've approached this problem with to try and reduce these risks.
That's such an interesting point on the behavioral biases piece. Part of me thinks, though, that if you're getting a team that's been together for a long time, the U.S. equity team, for example, to look at your own portfolio, I mean, that's not the most independent of lenses. Do you do things to solicit more independent thought on the portfolio?
We do. So a couple of things come to mind. One is that our former CIO, now chair of the firm, he's spearheaded this risk processes. And we do this formally twice a year. And as well, he's doing that with all the different asset classes at Mawer. And so he's able to bring ideas from other asset classes where he may see, oh, they've avoided, they're looking into these type of risks, or they're trying to change the portfolio to adjust it in these ways. And so he can bring those experiences to help us. That's one way of doing things. Another that's quite helpful is because we all speak the same investment language, we all have the same philosophy and process at Mawer, we can utilize resources from other teams and have them look at US ideas and look at the US portfolio. And it's a seamless process. And so over the last year, for example, we've had people from the Canadian small cap team look at US companies. Samir has looked at 3M, he looked at Apple, he looked at Adobe. And so he brings a different perspective to it. We've had Justin, who's been focusing lately a little more on technology companies. He has a background from MIT. He views things from a little bit different lens. He also spearheaded our lab, which is trying to advance kind of technology aspect of investing and how we work with technology at the firm. And so he's got a lot of experience in technology and investing. And so he's been able to bring some of those ideas. And he's looked at US companies over the past year. He must have looked at 6 or 8 different US companies in depth on top of many others. And so that's a different way of bringing kind of a fresh approach to things and a slightly different perspective. And so we've also found that's quite helpful on risk management.
I mean, for those who have listened to the podcast over the last couple of years, I mean, clearly that cultural element, the harnessing of different perspectives and of really allowing those to be voiced and heard by those who have decision-making authority is clearly a big part of what we're trying to do. I want to circle back to some of these themes, though, and maybe spend the rest of the time on those. So clearly a lot of themes impacting the world and the US in specific and US companies. I was wondering if we could go through a couple of these themes through the lens of portfolio construction and risk management and just talk through some of the impacts and how you're thinking through them. The first I had was with respect to e-commerce, with people working from home and a lot more economic activity shifting online. How have you seen that play out? And what are some of the things that you guys are thinking of as a US team from that perspective?
E-commerce has been a big one, you're right. So there's the obvious beneficiaries, and we do own some of those in the portfolio, Visas and MasterCards, PayPals, these type of companies where obviously you're not going to be using cash to buy things online. And so this benefits credit card companies. It benefits companies like PayPal. If you're buying new things during the pandemic from retailers that you don't know a whole lot about, you may want to be a little more safe about giving out your credit card number. So those are quite obvious ones. I think there's other themes that maybe are less obvious. I'll highlight one of those. Nike is one that comes to mind. So the shoe company has made a big e-commerce push the last few years. And so part of that is that they've seen this shift happening even before the pandemic. And so they've shifted their business so that they can sell more shoes directly. So historically, if you bought a pair of running shoes, you might have gone to a store in the mall. You go to a Foot Locker, that type of store. You try several pairs on, and then you come home. And so Nike would sell their shoes to Foot Locker for half the price that you see them listed on the wall at, and Foot Locker would make the other half of that profit. But Nike's trying to make that shift online and sell more shoes online. And so as a result, they control more of the ecosystem. They control more of their brand. They can capture more of that, of the total value of the shoes they sell rather than having a retailer make part of that profit. And they can see the inventory better. They can control discounting more. And so that's been one where you've seen a big e-commerce push and they've benefited from that. And so there are companies like that that are not quite as obvious as some of the ones that might come to mind immediately.
From a portfolio perspective, well, I've got 2 thoughts. One is just the benefit of a good management team, because effectively that relieves your job a little bit. You're essentially outsourcing some of those decisions to the management teams themselves. So Nike's the one who's got to worry about rising e-commerce. And if they've positioned themselves to have optionality, that's great. It's a stock that you continue holding. But thinking of the portfolio overall, the pandemic has clearly ushered in an acceleration of the shift to e-commerce. If that acceleration was really to increase, how would that impact the portfolio, or where are the companies that you would be most worried about in terms of what we hold today?
There's different ones that come to mind. So the obvious ones are retailers. We haven't owned too many retailers for that reason. Not that we saw the pandemic coming, but more that we kind of saw this gradual shift to online. And so we were kind of hesitant to own too many of these companies with a theme pushing against them on that front. There'd be other industries like real estate, commercial real estate. And so fortunately for us, we haven't had really no direct exposure to commercial real estate. We have recently kind of revisited that as this pandemic hit and a lot of those companies got hit pretty hard. We did set up a reverse roadshow and talk to some analysts in the commercial real estate area to make sure we weren't missing anything. And there's also derivative plays on companies that have gotten hit pretty hard on that front. And some of those we found are ones that we've tried to benefit from. And so I'm thinking of companies like Carrier, which is one we historically owned through their parent company, UTX, but they got spun out and we added to the position. And so Carrier makes air conditioners and furnaces, as many people are probably well aware. And so on the one hand, they get hurt if you believe that people aren't going to go have an office. They're going to work from home all the time. And so if you don't need an office, well, you don't need an air conditioning unit on top of that office building because you don't need the office building at all. It's shut down basically. But there are offsets to that. And so I think that's part of finding these investments is a company like Carrier has been hurt in some ways, but benefited in that, well, maybe in certain climates, you may want to have an air conditioner at home now. In Florida or something, you're going to have one, of course. But in more northern climates, maybe you didn't have an air conditioning unit because it wasn't that warm much of the year and you're in the office for most of the heat of the day. Whereas now if you're at home, you want to be a bit more comfortable. So there's some offsets like that. And there's some offsets with air quality and make sure the air is more purified, is circulating more. So upgrades to the system. And so that's what we often see with companies we try and invest in is that they find different ways to benefit from some of these headwinds.
Interesting. Let's shift to another theme, the winner-take-all nature of some of the business models that have emerged in the US. So I think about some of these platform companies, even the Visas and the Microsofts. There's effectively just a handful, one or two players who can really benefit from the scale, or once they get that certain scale, it's impossible for somebody else or very difficult for somebody else to come in. Is that a theme that you guys are thinking about within the US portfolio?
It is. So like many things, there's two ways to think about it. The one is that these companies are doing a great job at what they do is really why you've seen these huge companies continue to grow despite being big. I mean, there used to be the old trade-off. You used to talk about, well, you'd like to invest in small cap companies because those are the ones that grow faster. You either trade off the large companies, potentially better businesses and lower risk, and more diversified, versus a smaller company has more growth potential. And so you try and weigh the two and see what you think makes sense. The last several years, it seems like that hasn't quite held true because you have big companies like Google, or Visa, Amazon. These companies are massive. Some of them are trillion-dollar companies, and they're still able to grow at 20% a year, which is just unbelievable, the amount of growth that they're achieving. So it's a little bit different paradigm. And so, like I was saying, I think there's two sides to it. One is that they're doing a great job. The products they create are adding a lot of value in our lives. That's why these companies have gotten so big. You think about Amazon, I'm sure a lot of people listening to the podcast use Amazon Prime, order products from them. It's a great product. You get your stuff right away. You can get anything you want in a day or two. So it's an outstanding product. So you can see why people use it. Same with Google search or YouTube. These are really high quality products. And so you can see why you use them more. But we also look at things from a risk management standpoint too. And we have to be careful about not getting overconfident with these kind of companies. And so we regularly try and think about the downside. For example, as part of our process when we look at companies, we put together what we call a short report. And so it's basically trying to reverse our mindset and think about, okay, we have a lot of reasons why we want to own this company, but let's turn the tables and say, why wouldn't we want to own this? Let's think about all the reasons why we shouldn't own this company. And so that's quite a helpful exercise to force us to think in different ways to make sure we're not making any mistakes in terms of getting overconfident in the investments we make.
Related to this winner takes all theme, rising inequality seems to be a theme in the US and just globally in general. How does that play out through the portfolio?
That's something we've thought about. I like to think about these long-term themes, and I've done it the last couple of years. Around this time of year, I've put together kind of a paper basically on some of these longer-term themes. And longer term is in 100-year themes going back many decades. And you're right, inequality, wealth and income inequality are one of the big ones that pop up. Perhaps that's why you're seeing some of the tension you're seeing in the US and other parts of the world right now is a lot of people feel left behind. They feel like their life hasn't gotten any better in the last 20, 30, 40 years. And they view a small subsegment of the population as seeing a much higher quality of life. And that leads to that tension. So part of it is recognizing these theses. Part of risk management is just awareness of some of these themes. And so I think that's a big part of the battle is the way we work at Mawer allows us to think about, we're long-term investors, we're thinking 10 plus years out in the investments we own, and we're employee-owned firm. And so a lot of these things that we think about really impact kind of the firm, the clients, our holdings. And so that's just the kind of way we do things here. The way it pans out in terms of kind of specifically looking for risk is once you've identified this thesis, you try and see, really one of the big ones is that it's hard to forecast how the world is going to pan out. So we often use big themes like this as a way to protect the downside. And so we want to lower exposure to downside from things like the wealth gap or the income gap or tariffs or rising interest rates. And so we'll look at these things and try and find ways to reduce the sharp edges in our portfolio to lower that risk.
Are there things that we've specifically done on this theme of inequality?
I'll give you an example of a company that comes to mind in terms of something that came out of this wealth gap. One would be UnitedHealth. So UnitedHealth is a health insurance company in the U.S. And so their latest push over the last few years has been to really try and make healthcare more affordable. So when you think about healthcare in the U.S., I'm sure many of you on the podcast have heard about the escalating costs in the U.S. healthcare system and how they're trying to rein that in to spend less and still get good outcomes from the healthcare system. So UnitedHealth has really made the shift over the last few years to try and make healthcare more affordable. So they're trying to use their clout in the market and some of their strategic moves to lower the price of healthcare. So I'm thinking about things like lowering the cost of prescription drugs. So they're able to negotiate for better prices on prescription drugs on behalf of their users. And the same in terms of access to healthcare. So whereas a lot of people in the US would go to hospitals because they may not have a primary doctor, they may not know where to go to if they need to go to a doctor. UnitedHealth has tried to push people away from these expensive venues to cheaper venues where they can go to a clinic down the street or they can go to a clinic at the drugstore and see a nurse, for example. And so they're able to lower the healthcare costs for a lot of their users and improve the quality of life for them.
Great. What are some of the other themes that you're thinking through that you think are most important to the U.S. portfolio's resilience right now that are bigger picture in nature like this?
Well, one, you hinted at it a little earlier on, but one would be just the quality of management. I really want to reiterate the value high quality management teams can add on the risk management front. The one that comes to mind is Fastenal. So Fastenal is a distributor of fasteners, screw things together, which you would imagine would do not that great in a pandemic. They sell to industrial companies, and if these industrial customers are making less product because people aren't buying as much, you'd imagine that's not an outstanding scenario for a distributor of these products. But what they were able to do was they saw the pandemic coming a lot earlier than many people out there. And so they were able to proactively get a lot of PPE devices, for example, personal protective equipment, and bring those into their distribution. And were able to sell those to customers and have them in stock and provide those to their customers on the industrial side when the pandemic hit. Whereas a lot of others out there were having a hard time getting a hold of these devices because the management team just wasn't as proactive. They were kind of reacting to what happened. And after the pandemic got really bad, they try and call suppliers and get these devices, whereas Fastenal was just much more proactive on that front. And so I think that really highlights the value of management teams and high quality management teams in these scenarios where they can really lower the risk of these holdings for you and do some of the work for you, like you were talking about earlier, Rob. Another theme that comes to mind is oil. As a lot of us are working from home or have worked from home for the past several months, not flying places to talk to customers or clients, and not going to conferences, not going to trade shows. So this is clearly having a big impact on the oil market. And so one of the things we've done is to try and offset some of our risk on that front. So people are well aware of the theme and the lack of demand for oil. And we've been able to offset some of that risk in this kind of shaky oil market and invest in some of these companies that we've been well aware of for a while. A company like Aspen Technology has been on, we've owned it in the past and it's been on our inventory list for the last few years. And that's one that popped up in some recent screening. They run the software for refineries. And one of the things that they've done that's quite interesting is in these shaky times for the oil industry, they've been able to tweak their software to help these refiners lower the cost of running their refineries. So it's not just on the revenue front, so you kind of produce more oil, they make more money, but it's also trying to find ways for their customers to lower their costs. And so that's been a huge, huge win for them recently. So that's been a big one.
Yeah, what strikes me, Grayson, is that with respect to some of these bigger themes, it really does come back to the individual businesses, the individual management teams, and the risks that are embedded in them as one of the bigger staples of the portfolio construction exercise. So it does seem to me that it starts very much with the bottom up, and then you slice the cake a number of different ways just to make sure that that bottom up work is capturing the resilience that we intend. Is that an accurate description of what you're trying to do as a team and as a portfolio manager?
I think so. I think we're trying to combine the two. So like you said, very much bottom-up focus, but we're trying to combine that with a top-down awareness of some of the risks out there and some of the opportunities. One example would be companies like Accenture, Cognizant. So these are technology consultants. And so there's upside and downside risk with some of these technology changes. So there's certainly a lot of upside in that a lot of companies, especially during the pandemic, are trying to upgrade their portfolio. So they may be selling stuff online and they want to really upgrade that. Or maybe their website was just average before and they really want to improve their website because people aren't coming into their stores to buy stuff or into their warehouse. And so these two companies are ways we found to benefit from some of these shifts in technology. Of course, with those shifts comes the risk that technology shifts quickly. So you don't know who's going to be the winner. It's hard to pick who's going to be the next big cloud technology winner or SaaS technology winner, software as a service, or all these kind of buzzwords that you hear. But one thing we found is that we're able to hopefully find the right mix between risk and reward with some of these companies like Accenture or Cognizant, where they benefit from that transition to new technologies, but you don't have to bet on a specific company or a specific technology to win. You can just bet on that transition happening. And so there's ways you can manage that risk, like you say, and think about things from both a top-down and bottom-up standpoint that hopefully lead to a more resilient portfolio.
Last question. Are there areas that you feel that the portfolio is less resilient against? Or put a different way, what are some of the themes looking forward that you're most concerned about?
I think some of the themes that are most concerning from a real macro standpoint are ones that impact most of the companies in the portfolio. We've tried to slice it a number of different ways, and we feel pretty comfortable with the kind of risk diversification from that standpoint, thinking about input costs or things like this. Could be exposure to payments or auto aftermarket or however you want to slice the portfolio. Of course, there's always risks, but we feel like we've looked through a lot of those and feel confident that we've created a resilient portfolio. I'd say some of the bigger risks that I worry about in the longer term are ones that impact the entire market more so. So I'm thinking about things like a shift away from democracy could be one. You've seen kind of more talk about populism or authoritarianism, things like this, that they really don't impact a specific stock or specific industry so much as they impact the entire investable universe. And so those are some things that may or may not happen. Who knows? But you've seen some signs of a shift on that front. So that's somewhat worrisome. And there could be things like interest rates as well that are kind of more macro that, of course, impact the discount rate for investments. And That impacts the valuation. So those are ones too that can impact the whole universe that we worry about a little bit. That one's a little bit easier in some ways to find offsets. For example, we've invested in CME, which is the futures exchange. And so there's some companies like that that benefit from rising rates or rising volatility. And so we try and find ways to offset some of these macro risks. But I think those would be a couple of the bigger ones if I look out 20 or 30 years that I worry about.
You can worry about them, little you can do to control them other than to diversify even outside of the US fund that you're talking about.
That's right.
I suppose. Well, let's just ask then. So Grayson, I mean, we started talking about wanting a US portfolio manager, just given things happening in the US. I've got to ask the question. We've come through a recent US election. Not sure when this podcast will actually get released and that things could change between now and then, but any big picture thoughts with respect to at least the outcome that we know at this stage?
These kind of events are tough because it's hard to predict who a few weeks ago who's going to win. And then on top of that, it's hard to predict what's going to happen when either person wins. And then you have to predict how the markets are going to react. So what we found most effective in situations like this is the win by not losing strategy. So we try and look at what businesses, what industries could be hurt under different presidents, for example. And so you might say Trump may have poor relations with China, and so you try and avoid companies that export goods to China. Biden might have slightly higher taxes, and so we've looked through the companies in our portfolio and tried to understand which ones are most at risk to their tax rate increase and seeing if there's any extraordinary risk on that front. And we think the answer is no. We think we've kind of created a portfolio that's pretty resilient in both cases. And so that's how we tend to look at hard to predict binomial outcomes like that.
Got it. And I guess for a company like Fastenal, not a huge difference to their business model with respect to who becomes president.
That's exactly right. I mean, the type of companies you invest in are ones where they are resilient in all different outcomes. And so you see that in any sort of scenario. It could be who's going to run the country. It could be anything. It could be how quickly do we shift to e-commerce. It could be what our oil price is going to be 2 years from now. We try and buy companies that can do well in any scenario.
Well, that seems like a good place to end. Grayson, thanks for taking us through the lens of risk management and thinking through various themes in the U.S. portfolio. Thanks for coming on the podcast.
Great to be here. Thanks, Rob.
Hi, everyone. Rob here again. To subscribe to the Art of Boring podcast, go to Mawer.com. That's mawer.com/podcast or wherever you download your podcasts. If you enjoyed this episode, please leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Thanks for listening.